But they still have the problem. The problem is that the long-term problem, they're still obsessed about this deficit management and fiscal discipline. So everybody is into this austerity trap. So politically, what was happening in Greece, everybody was upset, etc. In Spain, people are upset. Everybody is trying to now squeeze the economy. So what you have is that the euro seems to be more stable than what it was 6 months ago, but unemployment rates are very, very high. And all projections are that the European Eurozone economy will contract in 2013. Right? Anywhere between a negative 0.2, it will contract by 0.2 to 0.4% of the economy. So roughly say a 0.5% contraction of the economy will take place. Even though the currency has, nobody is now talking about a euro crisis anymore, though it's still fragile, we don't know how the market will behave, but at least the bank has come up and I think made the right noises. In fact, little footnote, if you ask me if the bank had done this a couple of years ago, we would not have had this kind of seething crisis in Europe for this so long. And they would have been a little better. But countries like Spain and all have, if you look at the entrance into the labor force, young people 18 to 25, that age group, there's 50% unemployment. And that's politically also not very good. In a country, there will be a lot of stress, street crimes will go up, drug addiction will go up, all kinds of sociological phenomena, political unrest. Coming to our own country, what happened was that we were immediately after the crisis, if you recall very quickly, that we put in a big stimulus. The economy in the next year, first year there was a shock, 2008-9 was bad. Then in 9-10, 10-11 we had done very well. We had recorded 8.5% growth in real terms, which was very, very impressive. Right? And in fact there were expectations raised when Kaushik Basu became the advisor. Kaushik went and said that even if we do nothing at all to the economy, if we let it be on autopilot as it were, no more reforms, nothing, savings rate is somewhere around 35-36%, the incremental capital output ratio is around 4, so that tells us 9% growth we are almost assured of. And if we give it a little bit more of push and engage with it imaginatively, we can get into the double-digit growth and be a competitor to China in terms of growth rates. But that did not occur. In fact, that year that he predicted 9% and he said that the economy would be targeting around 8.6 or something, we slipped, and this year also we are going to slip. A quite remarkable slip in terms of moving from what was expected to be a 8.5 to 9% growth, we are now looking at 5 to 6% growth rate. Why? Obviously the big question would be, first of all, again a quick note that 5% by itself, if you look around the world, it will still be the second or third fastest growing economy. But then, so 5% is not bad by any standards, not in terms of what's happening to the global economy where people are happy if they can clock positive growth rates. But then given India's expectations, its own expectations in the very recent past that we were all dreaming about 9% and double-digit growth, suddenly we have slipped and people are asking why is that happening. Obviously it cannot be entirely for external reasons. The government keeps on saying it's external reasons, the global markets are very sluggish and slow. It cannot be because in that situation when global markets were equally bad, we were clocking 8.5%. So how did we do that and why can't we do it now? I think there are certain structural inherent features in the global economy, in the Indian economy, which bring about, an overheating if you try to grow very fast. Alright, so it's like you are trying to play aggressive shots, take quick singles in a one-day game, and by the 15th over, you're getting cramps and you're burning out quickly, you can't take shortcuts, your anti-coordination is gone. Sometimes it happens to the Indian team, so it's somewhat like that. But we suddenly sort of dynamized and then went into 8.5 more, but clearly that 8.5 more is not sustainable in the long run unless we take care of some of the more structural sort of features. How have we been performing? I'll come back to the structural features in a few moments' time. How have we been performing? If you look at the last say 2012 April onwards, the last 3 quarters of the current financial year. We have not done well. In fact, everywhere both our forecast expectations as well as actual first estimates of GDP are being rolled down. We are now looking at around, I think 5.5%, 5.4% growth. On the international front, what has happened is because of the slowdown, our exports have fallen. There's a contraction in our exports actually. Right? So there's negative rate of growth. Imports have also contracted. Imports, normally because we are still growing but there is a slowdown, imports should also have slowed down. It should not have registered a negative rate of growth. But remember, in India, many of our imports are tied to our exports. One of the biggest items that we guys know is gems and jewelry. We import a lot of gems and jewelry, we add value by cutting, designing, whatever, and then we export it. So obviously, if our export markets are down, we won't be importing those export-related imports. So that is coming down. And you add the slowdown in the economy, our exports are negative growth rates, imports are negative growth rates in the last 2 quarters, and our current account deficit has actually gone up. If the current account deficit, which has gone up in 3 months by around $6 billion or something, and now the last figures for November were around 22 billion or something deficit. How do we finance this deficit? Current basic economic theory tells us you finance this by capital inflows. Because if you have a deficit, which means you require more dollars to pay or euros to pay, so you allow more capital inflows to come in. Capital inflows can be of 2 types, as we know. They can be a little more enduring and durable in terms of foreign direct investments, where you set up a factory, you engage in actual hands-on brick-and-mortar businesses, so you can't quickly run away overnight, as it were, even if you get put off by the Indian market. The other is foreign institutional investments, which is portfolio investments, pure financial investments which get into secondary markets, bond markets, equity markets, and they can go away very quickly, right? So if they don't like the Indian market, they feel panicky, or nothing's wrong with the Indian market, but they find that Timbuktu is a better place to invest, they'll quickly move away to Timbuktu. FIIs have been very volatile in India in the last year compared to the previous 2 years. So we have had actually difficulty in financing our current account deficit, which has led to a rise in India's external debt. Not only that, our short-term debt has increased, so that if you look at the standard benchmark external vulnerability factors in the last 2 quarters of 2012, around roughly the period July to December, it has actually deteriorated a tad, but still it's a deterioration. Right? So on the external front, we are a little, careful, because remember we also have to import our oil. 85% of the oil we consume is imported, and oil markets are expected to be around $100 to $110 from this year. Right? That's the most of the predictions are. It's not going to. There's a lot of excess supply, but costs of getting that oil have gone up in the recent past. The operational costs of extracting oil. So oil is not going to come down. Now, if we have this exchange, this current account deficit pressures of financing, it will be hard to hold the rupee. We are seeing the rupee has been fluctuating, but in general it's a declining trend. There's a depreciation. So if we can't hold on to the rupee, then the actual rupee costs of a barrel of oil is going to go up, because the depreciated dollar, if it becomes, say, from 55 to 58, then $100 barrel will be costing more in rupees. So on the external front, there are reasons to be a little worried about. If you look at internal growth, if you look at and broadly subdivide the economy into agriculture, manufacturing and services, last few years, as you know, services has been the main staple. It has always grown at much higher than the average rate of growth of the economy. Agriculture still depends, fluctuates, depends upon the rain gods, etc. And manufacturing, by and large, has not been doing very well in the last 4 or 5 years, except for 1 or 2 years, outlying years. Here, this year, what's likely to happen for the first time, we are seeing, I think compared to the last 4 or 5 years, a slowdown in services growth. Alright, it's still growing at 7.5% or something, but compared to a 9%, 8.5%, it's slowing down. What about agriculture? Agriculture, again, the base effects show up, but last year, agriculture had a record food grains output. It's going to be very hard to predict. It was like 12.7 million tons more than the highest ever recorded. Alright, so it beat the last highest by some 240 odd million tons. This year, it's going to be hard anyway, even if agriculture does well. Now, the monsoons had not been good according to all measures. Reserve Bank has a measure, the meteorological department has a measure. It's been a deficit rainfall. So if you look at the two main food grain crops, Kharif and Rabi, for Kharif, there's all the first estimates of production show a decline. Oilseeds, cotton, rice, wheat. And for Rabi, we don't have still the sowing has been completed and we still don't have output figures, but we have sowing land area figures. There's been a tad increase compared to the past, but rice has fallen by 3%. So now if you put Kharif production falling and Rabi land area, particularly rice, as almost a 1/3 cutback in the area sown, then you are looking at a food grain. And remember, the base effect was we have a record. So if you take the base effect and take this, we are likely to have a negative rate of growth, or very close to 0 rate of growth for agriculture. So that's a worrisome feature. Now add to that the fact that we are having very high food inflation around 10%. And also add to that in terms of international commodity markets, which are now going to soften because of lower international demand, except for two commodities which are likely to actually get aggravated. One is wheat and one is maize internationally, because output has been lower and their stocks to use ratio is lowest in the last 30-40 years. So stocks are low, production is low, very, very unstable situation in wheat and maize prices internationally. What they might spike up suddenly. And then if you have an Indian situation where the food market is not that good, we can have difficulty. The government says we have enough of buffer stocks. In fact, we have much more than buffer stocks that we require. Alright, for FCR, etc. In fact, I think the government should sell that in the open market as much as possible or distribute it to some places, but they're not doing it for some unknown reason. They rather prefer to let the rats have it than have it for some unknown murderous reason. And they keep on, so whenever they say that maybe there's some problem, they hike up the minimum support price to satisfy the rich farmers, and then that gets translated into a higher subsidy, which gets pressurized into the public deficits. So agriculture again is not a good prospect. Services is slowing down, so unless it really does miraculously well in this last quarter, it's going to end up with a rate of growth than what it was in the previous. What about industry? Industry is not doing well at all. There was a little bit of improvement in October, but if you look at the index of industrial production in the last 6 months or so, it's not been good. Why? Again, particularly what are called the core industries are not doing well. What are the core industries? Typical infrastructure, coal, steel. These are the things that are not being doing well. Power. In fact, take power. In India, it's such a shame. We had a huge ambitious target of, I think, 55 gigawatts of power generation capacity, which we were able to fulfill in terms of created capacity. But to utilize that capacity, we require coal. Coal has become a huge bottleneck. Coal has become a huge bottleneck for a variety of reasons. New coal blocks, there were these corruption scams about coal blocks, they were supposed to be producing coal, nobody was producing coal. Coal India was in the doldrums because of their large deficits, even though they were able to raise capital. The IPO for Coal India was very, very good. And now, of course, you have these added problems of environmental clearances for coal, etc. There's a rather regulated industry and the environment ministry. So they are trying to now import coal, they are trying to have these assured supplies, they are trying to manage the supply chain of coal, but we are still down by, about anywhere around 25 to 30% of the coal requirement of power sector. And if power is not generating, that's going to draw down, pull down a lot of manufacturing from the supply side. From the demand side, since we are not growing very well, consumption expenditure has slowed down. If you look at aggregate demand components, or C as in learned in macro, C and private I have both gone down. Government investment has gone up a little bit, government consumption has gone up a little bit because government deficits are larger, they are trying their best, but they don't know what to do more in terms without creating disbalances in the fisc and apprehensions about management of debt. So we are not doing well on this front. We are going to end up with a low rate of growth. All right. We have problems on the international front in terms of having a very fragile kind of a debt situation. So if there's some additional shock that comes in, we'll have great difficulty in managing that. And inflation is around still the CPI. They have a new series that they have constructed. Consumer price index inflation is still around 10%. And the WPI, the wholesale price inflation, is still around 7.3%. It's still high. It's the highest inflation rate in all the BRICS put together. And till last year, again, countries, again, the government policy makers, Kaushik particularly, he's my friend, but I get irritated with him sometimes. Kaushik had been maintaining inflation is global, inflation is, everybody's having inflation. If you just look at China's inflation story between 11-12 and 12-13, they have brought it down from 6.1% to 1.9%. And clearly what they were doing was, initially there was inflation going on because what had happened in China was very simple. They had focused their investments on exports. They were looking at the global market. The export market collapsed. The domestic market did not have the purchasing power to absorb what were going to be American market or the Euro market. They created that market. They created that income. What they were calling in Chinese language, they were calling it a rebalancing of the economy. And so what they have done is that they have kept that capacity to produce, but they have tweaked the goods, and they have created enough income now to allow consumption to increase. So the Chinese are spending merrily along. And inflation has softened because there are a lot of goods, there are a lot of buyers, and that matching can take place within 1 year. They were able to do quite a remarkable job on that. Plus they have got into a large amount of fiscal spending, etc. In this context between India and China, let me mention just one thing, and then I'll talk 2 minutes about Japan, and then I can shut up and I can take questions. You may hear again a term, particularly in the Indian media, electronic media, print media, that let's talk about policy space. What is policy space? It's again a buzzword that people are talking about. Policy space is something that, normally, first take inflation. If you have inflation, and if you immediately look at the central bank of your country to do something about it, then the standard remedy is they bring down the rates. And that's supposed to pick investment expenditures up, demand up, output and income. That's the standard textbook kind of. If you already have inflation high and your rates are very high, alright, if you bring down your rates, you're worried about pumping in too much of money into the economy through that and fueling inflation even further. In fact, once you find inflationary pressures building up, the typical central bank route is to raise the rates. So they've raised the rates, according to them they've more or less curbed inflation, they've at least contained it, though it's still at a damn high level if you ask me. And everybody thinks you should bring it down. RBI is worried if you bring it down, you're going to bring this up. Inflation will go up. So they're saying we don't have any policy space. If you want us to have a hit on output, we are going to create a lot of inflation, nothing can happen to output, and we don't want to be party to that. negative adverse consequences. What about the government? The fiscal policy, what can Chidambaram do? Chidambaram can create high deficits by spending more, reducing taxes to boost the economy. But he already has a huge deficit, and if you increase the deficit, then you are worried about your debt, ability to service the debt, how the market is going to perceive it, would there be a sovereign debt crisis, how do you handle that debt, the sustainability of the debt, all those other questions will come. So the FinMin is saying that I don't have policy space because typically I should now be looking at spending in the economy to boost it up from 5% to say 7-8%, but then my deficit will get out of hand. So the FinMin is telling RBI to cut the rates. The RBI is saying, you guys cut down your subsidies, take away some of the unproductive expenditure, and then spend it on more directly, sort of, maybe increase your Narega from 100 to 200 days or whatever. That would create employment and demand for goods and services. Right now, we don't know what's going to happen. It's a little bit like who's going to blink first. If you look at the last 29th of January, where Subburao said, he's now saying it's a calibrated move that he's going to do. So he has done a 25 basis point reduction in the repo rate. I think SBI is the only public sector bank that's again said that their prime lending rate will come down a little bit. So they're saying we'll have to go very, very cautiously and slowly. FinMin is saying, okay, we are doing fiscal consolidation, we are trying to cut back on our subsidies. That's why all these administered prices have gone up, coal, electricity, LPG cylinder, diesel, everything has gone up, which will contribute to short-term inflation, no doubt. Hopefully in the long run, they will manage the deficits better, and to that extent, inflationary pressure will be a little lower. But they are saying that, look, if we're going to, we can't increase the deficit, what we can do is we can switch some of the expenditures around. So if we cut back on subsidies, but again, if you cut back subsidies all of a sudden, all of them, to which the Indian economy has been so long used to, it's going to create inflation, and it's going to create a lot of political assets for an already unstable. Everybody will start saying that we don't like these price rises, what the hell, and election year coming up. So I don't think they can create the fiscal space. I don't think Subburao has the monetary space to do anything. So in the short term, if you look at the next 2 quarters, 3 quarters, we are looking at a double-digit inflation somewhere around 8 to 10%, and we are looking at around 5–5.5%. We don't have that policy space. Look at China. China had a surplus in the fisc to begin with when the crisis began. So they can reduce that surplus, they can get into a little bit of deficit and still stimulate the economy without having to worry too much. Okay? And if you look at the rates also, Chinese Bank of China, the inflation rates have been brought down. Right? So now the rates are still a little high, but since the inflation rate has come down, if they still want to stimulate, they've got some monetary space also. They can bring down their benchmark rates, whatever they call it, by a couple of 50 basis points or 75 basis points quite easily without worrying too much about inflation. So on inflation and budget deficit, for instance, China is much better. If you look at the other BRIC countries, yes, they are not as well as China, but they're certainly better than we are. So Brazil or Russia. Russia, I think, has a fiscal surplus, but Brazil has inflation, has a deficit, but still a tad better than what we are in terms of the space that they have for One quick point about Japan, and I'll close there. Japan, something interesting is happening. Japan was the first economy, if you go back to the 1990s, which stagnated, which was not able to get out of a recessionary kind of a trap. It was getting into a zero-rate growth. The Japanese government was trying to stimulate monetary policy through fiscal policy. Nothing seemed to be working. Remember, they're still a very high-level economy in terms of their per capita GDP and all that. But they were unable to grow the way they had grown phenomenally in the 60s, 70s, and even in the 80s. Okay? That started to slow down in the 80s. By 90s, they completely sort of became stagnant. Then they were showing some positive rates of growth. But then what happened was, again they got hit by the recession, global recession, as well as then they got hit by this tsunami, which was an act of an external shock, as it were, a supply shock. The Japanese conventional wisdom had been the kind of wisdom that now seems to be around the world, and be conservative. Money supply is not to kickstart the economy, money supply is to control the inflation, and the deficit management is more important. Government should not be trying to stimulate the economy, leave things to the private sector. The very conservative conventional wisdom that became very prevalent from the 1990s onwards. Japan was again very cautious about using monetary policy. They had brought it down, but they didn't go into quantitative easing, and now they brought it down to 0.25%, I think the first one. And they had a bit of a deficit, but they were not going to play around with their deficit. And they were saying that the economy is sort of satiated, as it were. How much more infrastructure can we build? How many more bridges and roads and houses can we build? It's physically a small economy, few islands, etc. What has happened is this new PM, Shinzo Abe, he has come up and he has taken a very bold stand. He has told the Bank of Japan also to double the inflation target. They're saying we don't care about inflation. Anyway, it's very good, 1%. He's saying, Janero, let it be 2%, 2.5%, we don't care. You just pump in money like there's no tomorrow. And they have started quantitative easing. And you can understand on a monthly basis, the Fed is injecting something like 85 billion US dollars. The Bank of Japan will now be, given their program that they have announced, be injecting somewhere around 145 billion. Roughly, almost double that of what Fed is doing. So they have gone on a heck of a spree of using the standard Keynesian tools, and they have announced massive government expenditure programs. They are saying, chalo, let us see what happens. People have always been saying, oh, there's going to be inflation, oh, there's going to be a deficit, and national debt problems. But the standard wisdom of the 30s and 40s and 50s were that we use these to pull the economy out of the trap. Maybe we need more of that medicine rather than we worry, give under medication. So it's like having antibiotics, if you give lower than the dose, it's not going to be able. So they're saying just, load it into your bloodstream and give molecular doses of antibiotics. So Japan is like into an experiment mode. People are divided. Economists is like a house divided on Japan. Some people are saying this is a surefire path to ruin. Alright? Other people are saying, like Krugman and all, that Salam. You have done the right thing. Japan will teach us. They were the first to get into the stagnation. They will be the first. So Japan will be an economy to watch what happens in the next 6 to 9 months. Alright? Whether Japan can grow, Japan does not have inflation out of control. It's saying up to 2.5% inflation, we couldn't care less, but we want people to go out and spend on goods and services, and we produce the goods. So this is very roughly the state of the world economy. Very quickly giving you what the short term features are. For India, it doesn't look very good this year. But hopefully we should be. A lot of reform measures have been announced, but many of them are not announcements and actual measures. So it may not actually have a short-term effect on the economy, except again the psyche of the investors. If everybody pleased with the government, if they announced investments, announced reforms, and if investors turn around, that's good for the economy. But I don't think investors are that easily viewed. I'll take questions.
So there have been rumors about GATT, and then Parthajatic Home Committee has almost revoked that. But that has a very bad negative effect on investments all over India. The amount of investments that are coming in, like they thought that after the Shom committee report it will become reverse itself, but it didn't happen. What do you think is the reform thing that most investors are looking at? I mean, what exactly, like what big ticket reform are they looking at? If that happens, then the investors will come back.
There is no very big ticket reform on the cards. The only thing is that if they can go in for, they've announced some disinvestment programs for public sector companies. The IPO market is not very good, but hopefully they're saying that if they get in and like Coal India, etc., if they can do it, they can increase their non-tax revenues and receipts to some extent. That could generate a lot of positivity. On GAR, I think Chidambaram has been making noises that it's not going to happen. And I think the government has taken the lesson that if you do that, it's going to be very, very alarming for companies, and you're going to kill investment intentions.
But just the announcement has had an effect. I mean, the amount of investments, PE investment, everything has gone down, almost 40-50%. And after the Shom committee report, the things have not gone back to the previous levels.
No, because I think they're going to wait for this budget. That if there is a formal announcement in next month, end of this month or next month, that what Chidambaram says in the budget about, they make some announcements, Obviously it's not going to be built into the budget at all, but what happens? Now, Vodafone is having a private sort of battle. Vodafone is now asking for other kinds of compensations also, which is like a corporate scrap with the government. On that, I don't think people are going to be worried too much. But they're going to be worried whether that as a principle, alright, is going to be accepted or not, and I don't think it will be accepted. Yet, if you look at it from the pure accounting point of view, and if you look at it from the IT people, I was talking to a training program for IT commissioners, and they were saying that, look, if you ask us to look at the tax possibilities and where the tax lies, so obviously you have done this to avoid tax, and therefore if I'm going to get that tax, like if I find you telling me that if I have not paid my taxes, they're going to slap it back for the last 3 years or so, then I'm going to do it for all the years. That's the only way it makes sense. Alright? Otherwise you have to change the law, you have to just say that there will be sort of a one-time penalty of something, but then you still have to close that loop. Suppose I observe the Vodafone government case, and then I say, okay, the government is not going to tap me on this, so I do exactly what Vodafone has done, and then pay a fine. That the IT people are very, the IT, the collectors, the tax collectors are worried about that. I don't know how it's going to play out. It depends upon how government can ensure that people don't take the government for a ride, and yet, there's no apprehension that the government is unfair or slapping things from 1960 onwards. People were worried that, if they do it for you, they'll find my books and they'll open it. Somebody can say, file a PIL, and why is the not being done? He's done the same thing for the last 40 years, so why not open his books and do it? Tough thing. Accountants are crazy.
So you mentioned there's some structural features in the Indian economy that drive us to overheating in the growth. Could you elaborate on that?
Yeah, one I think is essentially our infrastructural constraints that we have. See, coal, power, there is very, very little, in my opinion, you will disagree with that. If you look at the infrastructure, the core industries, I would think a very balanced kind of a growth plan is there. Not necessarily everything financed by the public sector, but you should have a balanced growth. I'll just give you one example. See, to do business, you require many kinds of infrastructure. If you look at India and look at the last 10, 12 years, telecom as infrastructure has done remarkably well. Right? In fact, globally people are talking about telecom. But we haven't been able to do it for power or roadways. Roadways, maybe after a lot of effort, we have just built that tier 1 golden quadrilateral. But if you look at tier 2, tier 3, the broader network, we are in a mess. Coal, electric generation, steel, we are not doing well. We need much more capacity, much more balanced growth. You can have the best telecom system, but if you don't have power, you're not going to get anywhere. That I think the government has not done. So it's like saying if you want to grow at 9%, if I were Montek Singh sitting on the planning commission, I would have said that look, if I want to sustain 9% over the next 10 years, I have calculated 10 years, what would be the size of my economy? For that, what kind of supporting infrastructure they require, and for that, these are all long, big ticket, long gestation investments. You can't build a steel plant overnight. So, how much do I spend today? And I do it for each of the core industries, so I have a balanced kind of a growth path that is in place. And then I go beg for a steel. They say, keep saying, if there are investors in Mars, get the investors in Mars. I don't care about the color of your skin, the color of your passport. Whoever you are, go invest there, and we will give you a good deal to invest and make profits. But do that. And build a steel plant is not like a portfolio, a financial company, JP Morgan takes his portfolio, not like that. You can't take your blooming steel plant. You'll at least have to sell it to somebody. Okay? So you build permanent durable assets in my economy, build the roads, build the power plants, build the steel plants, whoever is local, I don't care who is doing it, but let me do it. That would create one. The other, of course, is agriculture. Agriculture, it's easier said than done.
So on that,
you require
infrastructure, what government initiatives have been planned on? Do you have any idea?
No, they're just spending that. They're saying they've opened it up. They're willing to allow, private sector participation.
Would private sector be allowed to release bonds in the Indian market, infrastructure bonds, if they want to raise money in India? So suppose Morgan Stanley comes in.
There's nothing against it, but there are certain limits of the debt that they can raise. And those companies also may not want to raise a huge amount of debt. But essentially what you require is that there has to be a stable regulatory framework, that if I'm going to build a power plant, whatever environmental laws, etc., whatever you have, it should be, you don't keep tweaking it every 3 months. Then I'll say, do your homework, get your mind stable, then I'll come to you. So you say, this is the regulatory framework that I have, and you come in, it's a long-term thing, don't be worried, I have some labor market controls also, alright, and just to show that I'm interested, I'll put in a 7 or 10% stake. Alright, I don't have the resources, you come with 90%, I'll chip in 10% just to show that I'm with you in what you're doing. I would say if I were, in government, I would have given that kind of an advice. That's probably the only way of doing it. And you require that balance. One sector you open up and the market works in its own way. So some of the telecom thing has, if you look at the evolution of telecom, it is gone off very well. Power sector hasn't. You guys won't remember, somewhere in the 1990s, you had this Enron coming in, and there was this double power plant in Maharashtra, and a huge fiasco about what was happening. Those kinds of things, and that time I was monitoring the power sector. I remember in a period of 12 months, 1 year, there were 22 changes in regulations. Who's going to invest in long-term big ticket items? If the government keeps on changing, you don't know when they're going to change it in such a way that you are squeezed completely. So you have to provide a very mature, stable regulatory environment that this is what we want. And then, as I said, you get whoever comes, you're building permanent assets. They're going to run away with your steel plant once they build it. Who's going to run away? They can't kill workers in India. They can't pay, exploitative wages. You have all those built into your regulation. Nobody wants to do that. You can do good business and still make money. Who will do that? If you have problems, let there be. There will be labor problems. Everybody knows. Honda is facing problems. Maruti is facing problems. There could be labor problems. You can't do industry and manufacturing without the possibility of doing it. But it doesn't mean that government says that if there is labor problems, they will not do anything. There has to be labor legislation. You know what the rules of the game are. You have a very quick, efficient, decisive legal process. So if you need redress, if you need a court case should be settled reasonably fast. It should take 3 generations to resolve a court case.
So, you mentioned that Japan is spending around, the Bank of Japan is spending $130 billion in terms of per month basis to what increase spending. What is it exactly doing to that people spend more? It's giving out loans at a very attractive. How is it injecting so much?
Loans are low. They are buying a lot of the taking this corporate bonds as well as government long-term 10-year bonds. Alright, and if the government long-term debt is being held by the central bank, that's pretty pushy, right? So everybody is happy in that sense. They've just begun it, so we don't know whether it's going to work or not. But then the government has made a lot of new projects and programs for employment generation. And employment seems from that. Okay, but they're just not growing. People are not going out and buying. Some people said it was a population that was doing the mess because, like if I'm given my age and your age, right? I'm not going to be thinking of changing my cell phone every 12 months and looking at a new set of clothes 2 years. Yeah, I'm like at the end of my innings, looking at a pavilion where I'm going to go. So I'm not going to go out and spend the same way the new guys will be spending, right? So even if I have a lot of, my income may be higher, I may have a higher wealth than you guys, but my needs may be in a good area. That was pretty what they were saying. So they wanted to create a fear of inflation. Anyway, deflation was occurring. That if there is a fear of inflation, the expected inflation goes up, people normally prepone their buying. So they wanted people to prepone their buying and start increasing their expenditure.
But Japan doesn't have a young population.
No, it doesn't. That's why they were saying that could be one reason why people are not picking up. We'll see how it works out. That because of the demographic profile, that even though there's a lot of liquidity, a lot of easy loans available, the old are not going out and spending on repeat purchases. They eat little, alright? They don't change their clothes that often, their wardrobes. They change their clothes. They don't need necessarily sort of buy new clothes and whatever. They don't travel that much. They don't go and eat out that much. I don't know. I've read that. Some people have said that it's the age factor. But let's see. Japan will be something to watch out for the next 6 to 9 months. So this is where sort of an old strategy is being worked out with a vengeance. No halfway streets. We do it the whole hog and see what happens.
Sir, there is a high burden on agriculture in terms of people dependent on agriculture. So why could we not shift that labor to manufacturing or services?
The way manufacturing, modern manufacturing has been growing and the way service sectors have been growing, there are two requirements. One is it doesn't require too much of people. There's still some people who are moving out. So there's very little new jobs that are being created in industrial manufacturing. And in the services sector, there are jobs created, but most of them are very high-end skilled type of jobs that you guys will be going in. Right? So that is, Khetibari said directly you're not going to get that. So now in fact, if you see, in fact I'm writing a book on that, and if you look at the kind of development interventions in the Indian economy, we are trying to sort of contain people within agriculture by giving them a little bit of extra livelihood opportunities, extra incomes, 100 days of employment, that bahar mat jao, because if you go out, there ain't any jobs there outside and you'll create social stress, and you'll not have to urban areas. So you don't have to go in for distress migration, we'll try and provide some additional income in your home base. That's only marginal. I don't think that's going to be anywhere like if you had an alternative job in the urban sector, in the formal urban sector. Or people come and hang around in the informal urban sector, servants and maid servants and chauffeurs and small shopkeepers and peddlers on the streets. Those are essentially people who have come from the villages and do it.
But those can be shifted in manufacturing sector by some technical development or technical training.
Technical training, but see, Anup, India's manufacturing sector is not short of labor. The kind of technologies that we use, etc., we have enough of labor. It's a populous country, there is no shortage of labor. Unless we change our technologies to become more labor intensive, etc. Also, one reason that I think my colleague Anup wrote on this one, it's an interesting hypothesis. Think about this, the labor market in India, the labor market is very well protected. The logic has been, the rationale has been quite apparent that it's a labor surplus economy. So there will be a tendency that for every worker who's in my factory, there are probably 5 people waiting outside who want to take his job. So I might have, as a Malik, I can have a tendency to mistreat you, not giving you wages, kicking you out at the first opportunity, slave drive you, because I know you're easily replaceable by 5 kids who are waiting outside. Right? In this circumstance, the government has made it very difficult for me to fire. Alright, or if I'm not doing good business, if I want to shut down the plant and I want to lay you guys off, I have to take state government permission, central government permission, tremendous problems. So what I do is, alright, now you don't have an incentive. If you know once you've got in, you don't need to be very productive. It could be that you may be shirking, knowing fully well that I can't chuck you out now and get the 5 kids in. The other thing is when I go in, so what I know, for me then it becomes, labor becomes like a fixed cost instead of being a variable cost, that once I have hired you, I'm stuck with you. So when I go in for a new project, I'll ensure that the technology that I choose, the processes that I choose require minimum of skilled or semi-skilled or unskilled workers. Alright, skilled workers, managerial staff, I can move around, there's always space there. So I can take the MBA, but I won't take the shop floor foreman or the unskilled worker as minimum as possible. So it's a very strange sort of, because there's a surplus of labor, we have tighter labor legislation to protect the worker, and because of that, people look at labor as a fixed cost and they go in for technology as a labor saving. So we need to create that kind of a trust that yes, it's a mobile, and the only way it can be done, in my opinion, if we have a very good social safety. So that he knows if I even chuck him out, alright, he is not going to die out of hunger or something, or rot in the streets. And the guys who are waiting outside also know at least for food and some shelter, they're assured. Okay, maybe their dignity is still low, their self-esteem is low because they're unemployed, they can't find the work that they want, but biologically they're safe. But here, we don't have that kind of guarantee. If you look at the total labor force, there's only about 9 to 10% of workers who are in the formal sector with some kind of protection. The rest are absolutely sort of out in the open, you don't know what's going to happen.
So there have been certain reforms in the foreign equity in retail. So what is the scenario? FDI in retail. So how would be the scenario when the foreign player comes, and would it be good for Indian economy overall?
Okay, given the kind of reforms that they are driving, political wrangling, that states will have to decide, etc. So you can't go in for economies of scale. Maybe Bengal won't allow, but Jharkhand will allow. So what do you do? Will your trucks be stoned in Bengal? Currently, I don't think FDI will come in any big way. 1 or 2 fellows may come into the big metro areas to test the waters on a very small scale. It will have no impact either way, good or bad, on the Indian economy. It will be too insignificant. That's my point. But if FDI did come in, there would be 2 things, I think. One is, they're forcing the FDI issue very quickly because of the foreign current account deficit that is economic. Foreign lobbies could be there, but I'm saying from the pure economic point of view, they need more durable, long-term capital coming in to be able to finance their current account deficit that they have. FIIs are iffy and very, very unstable at the moment. Risk averse, they say, or international investors. If it comes in a big way, what happens to the Indian economy? I think in the long run it will be good for the Indian economy. In the short run, there will be some displacement in the first 2-3 years when the thing is stabilizing. there will be displacements of the typical what I call mom and pop shops, alright? So the small dukan, you know, I don't know if you guys ever go out, you get your stuff from Mohan normally or the cooperative, or you go to South City or something. Ever you been to that shop right outside our main gate? Dilip is the shopkeeper. It's a standard sort of, you get aloo piyaz, you also get your toothpaste and biscuits. Huh? That fellow, when I came to the campus in the early 90s, he used to do roaming business. All of us used to have, you know, we used to go and give him a list of my, you know, monthly sort of dal and masalas and whatever, you know, mustard oil, cooking oil, and he would deliver it at home and he would do it. Ask him now, he's weeping. He's saying, nobody comes to me. I go much less frequently. You know, we go to Spencer's and pick up our stuff there. So obviously these kinds of jobs are going to happen, but there will be other kind of jobs created. Because once the supply chains get up, once we have a more sort of you know, well-designed and integrated cold chain, if they come in a big way, we're going to get that. That I think will create other kinds of jobs. So on net, if you give it another 5 years or so, a critical mass of FDI in retail comes in, I think it will be good for the economy, and on net, on the employment front alone, we get a net generation of employment. 2-3 years, we'll have a bad time. You know, there'll be a learning and there'll be some kind of displacement that is bound to happen. Once again, if we had some kind of social safety net that, you know, if you look at it, one is saying, as an economist, you are saying there'll be net generation of employment, both good. But look at it from that chap, if you don't want to be the chap who's going to be out of work. You know, whatever may happen to Bharat Nirman, you don't want to be the guy who's going to, you know, feel the brunt. So obviously, we'll have to look at it from individual human needs and challenges, where how can we ensure that nobody is left out in holding the behaviors. That we have never given it a serious thought for the last 16 whatever years. It's high time we thought of the social safety. But we haven't, I don't know. Part of it is my generation's fault.
So with this, if you have any more questions, I can maybe take it offline. We will take the session now. Big thanks to Professor Sinha for